Hi, this is Chris Buss with Traders Profit Compass. It's 11 a.m. on Wednesday, June 16th. We're about 3 hours from the FOMC statement release, and then there'll be a presser at 2:30. What I want to do in this video is go through all the SPDR ETFs, the sectors on the daily charts. It's been a while since we've done that. I'd like you to take this opportunity to take some notes on the pivots and the resistance and support levels that I give you. That way, coming out of the FOMC, if you take the time to set some alarms, I think it'll become clear as we move into next week what kind of regime we're going to be in. And we talked about it this morning. Are we going to be in a falling rate environment, or are we going to be in an increasing rate environment? And whatever way those interest rates break and the US dollar breaks, I think it's going to have a profound effect on which sectors take off and which sectors roll over. So let's take a look at it. Starting off with XLB, which is the material sector. On the whole scope of things, I think it's the smallest market cap within the SPDR complex in relation to the whole S&P 500. But that doesn't mean you can't make any money in it, because as you can see off the November lows, very nice uptrend as resources and commodities take center stage. This is the sector with, Freeport McMoRan, all the gold miners, all the aluminum guys, all that kind of stuff, specialty chemicals, commodity chemicals, all that kind of thing. So you can see we've broken the primary uptrend line. So that's, in and of itself, that is bearish. And now we've got price sitting on the 50 EMA, which I have at 84.57. Now, if this breaks below the 50, then I see a path down here towards 81. On the bullish side, what the bulls want to see is an up move that takes out, that recaptures 86 and recaptures the 8 and 20 day moving averages. So I think the next trade is the following. I think on a break above 86, you would want to be long. That would be a signal that resources are bouncing back on the recovery of this big volume over price resistance level, and then recapture those fast moving averages, and then have the PPO flatten out at the zero line and then start to curl higher. Likewise with the RSI, you see we dipped below 50, which is in and of itself bearish. You want to see that flatten out and then break back above 50 and get back in its bullish regime. So on the downside, like I said, if you lose 84 and then you're below the 50, if you wanted to, you could short XLB against the 50. So you would be at 84. You could set your stop just above 84.50, and then use your 50 as your pivot point going forward. And if resources continue to correct and sell off, I think there'd be an opportunity to see price move down towards 81. Let's move on to communications. This is the sector where it's basically you're trading Facebook and Google, which are 44% of the index. You can see nice uptrend. I've got a little intermediate trend line here off of the May low, and but with price above all the fast moving averages. Here's the 50, the 20, and the 8. So price is above all the moving averages, which is bullish. But I want you to take note of the divergent high. So we're at the highs, but we're at lower momentum levels, and kind of hard to see. It's not as dramatic, but at lower RSI levels. So that could portend, a pullback. And I've got an intermediate generous trend line here that's dashed that could see price come back to 77 where the 50 resides. So if interest rates start to take off to the upside, that'll be a headwind for tech. That'll be a headwind for the fat man names. Facebook and Google may struggle in that environment. I don't think this is some kind of big short here. I mean, Google has been very strong. Facebook has been very strong in recent trading weeks. So even if those weaken a little bit, I don't think that's going to be a dynamic short. What I would rather do is set yourself an alarm at 80.50 or 81. And if tech takes off and you prefer trading an ETF rather than Facebook or Google directly, I mean, this is about as good a proxy as you're going to get, being, nearly half of the index. So if this takes off, you can get long on, say, a break above 81, and then you can set your stop just below and look for higher ground. What would happen there is PPO would break through this downtrend line and turn up, and RSI is already in its bullish regime, so that'll turn up as well. So I think this is more of a long candidate rather than immediate short. Now, what would change that is breaking back below 77. If this came back here and then lost the 50, lost 77, then I think you've got a short on your hands, and that would be a good trade to take. So you may want to put an alarm there because you'll forget about it. So on the high side, I would set an alarm at 81 to get long, and I would set an alarm at 77 as a potential short if big cap tech falls apart. Energy has been very strong. If you're familiar with my work, that I'm an energy bull. I think there's some structural things going on with oil that I think there's going to be a bid through the summer, but we gotta work off the charts. We can't just have a grand thesis and not have the charts confirm it. So let's see what we got. We've got a rising wedge here. We had noted this level at 52 in the past. We got a nice bounce off of that, and we've been grinding higher, not impulsively. I think the energy equities have been kind of lagging the commodity because, oil is up every single day, and you can see that price has not really responded in kind. Now, that's not bearish, but you would have expected and hoped for more impulsive upside action. But it is what it is. We're above the 8-day. All the moving averages are bullishly stacked. The one thing I do not like about this chart is we've got a divergent high. What do I mean by that? Well, you can see back here at this high, we had relatively high momentum and we had relatively high RSI. As we come to this peak, lower momentum, lower RSI, and now as we've worked higher, still lower momentum and lower RSI. So while oil continues to rise and continues to seemingly have a bid under it, this chart is running out of gas, and that makes it vulnerable. So I've got an intermediate little trend line here off of the April low. that comes in at about 55. If energy starts to fall apart, I think there's room from 55 to 52. You'll have to decide if that's a short worth trying. Basically, what you'd be doing is getting short below the 20 EMA. That's where that comes in. I have that exactly at 54.50. So you'd have to decide, are you going to try and play for $3 down to 52 if you want. I would alarm 57 on the top side. And if there's a big impulsive move to take out this trend line and break higher, I think you can be long against 57 with a stop just below and see if this takes off and price can burn through these bearish divergences by turning up, heading higher, and likewise with RSI. But energy's been one of the stronger sectors. I'd like to see a little bit more dynamic price action in this. And remember, while we're on the topic, XLE is dominated by ExxonMobil and Chevron. I don't have the percentages handy, but I think it's in the mid 30% range. So Exxon and Chevron are a large part of this index, cap weighted. So if you wanted to, if you got that alarm at 57.50 and you didn't want to be levered to those majors, Chevron and Exxon, you can dive into the charts and select boats. What I mean by that is individual names. XLE is the tide. Your individual names are the boats. And if the tide is rising, then the boats will rise along with it. You've got names like, Fang Energy. You've got Continental Resources. You've got Pioneer, PXD. A lot of EOG is another nice name. Mid-majors, good companies, but more levered directly to oil because they're producers versus Exxon and Chevron that have a lot of, refining capacity and a lot of different parts to their business. So you might get more juice in an individual name versus just XLE, but that's personal preference. Moving on to financials. Uptrend line off of the November low. Rising rate environment. Remember, rates bottomed in August, I believe, and they've been climbing from 50 basis points up to most recently 175, and now those rates have backed off. And now we've got financials breaking the uptrend line and pulling back to support at 37. We've got the 50 EMA coming in at 36.64. And we had bearish divergences in place. Why? Again, we're at a high in price, but at lower momentum and lower RSI. That's always a yellow flag that high might be vulnerable to a pullback. And we did see it here. So where price is, we're below the 8 and 20. So that's a yellow flag for bulls. You want price to be above those fast moving averages. So now we're below and we're pinched between lateral support. Notice the large volume over price bar here. So we've got lateral support coming in at 37 and we've got the 50 at 36.50. So we get the announcement and then we're going to have a reaction, right? Into next week, if you see price lose the 50 EMA, set yourself an alarm at 36.50. If you see price start breaking below, I think there's going to be a shorting opportunity in financials if that were to happen. If we go the other way, I think you'll be able to see it in the charts with this 37 holding, and it starts moving higher. I think on the recapture of these moving averages here at 37.50, that would be a great place to get long for a re-ramp, and then you can shoot against 37 with a stop just below. So critical spot here on XLF. It could either break down or hold and go higher. And I think, it's going to do one or the other. And I think it won't be wishy-washy. I think rates will either start taking off or they're going to tank. And whatever way they go, I think financials is going to follow it. And just like the same commentary I had with energy certainly applies to all these sector ETFs. I mean, XLF has banks and insurance companies and Berkshire Hathaway and, all these different kinds of financials. And so it's not going to have the same type of price action as you would a JP Morgan. So if you're a guy that wants to identify a rising tide, then go find the best boats that are going to be able to capture that, then you go into the charts and you look at the banks, you look at the asset managers, things like that, and you can look at Goldman, look at Morgan Stanley, look at all the money center banks, JP Morgan, Bank of America, Citibank, and you can even look towards the regional banks, because the regional banks, unlike the money center banks, they're more a direct play on rates. You can look at KRE, which is the ETF for regionals. You can look at Key Corp. You can look at PNC Financial, that Truist. Those are some names in the regional banks that you may find some really nice setups in. Industrials. Nice uptrend off the November lows. Broke the primary trend line, bearish. Now we're sitting here just above 102 where the 50 EMA resides, and just below the fast moving averages, the 8 and the 20. So just like the financials, we're between the 50 and the 8 and 20 on price. I think this one is a simple setup. As long as it holds 102, I think the bulls can take solace in that. If 102 holds and there's a bounce off the 50, I think you get long. But if 102 fails, I think you could see a move back into 98, 97.50, because there's not a lot of lateral support down in this void. So I think if they go after industrials and they knock this down below the 50, I think you've got a nice short there against 102 and the 50. Set your stop just above, 101, whatever risk you want to take. So let's just take a look at that. If we're breaking down below 102 and you take the short there and set your stop at 103, you've got $1 of risk, and you've got potentially $4 to $5 of downside, and that's a great risk-reward trade. Risk $1, $1.50 to get $5. That's a nice trade, and like I say, if that breaks, I think that may potentially be a fast move. So that's industrials. Here's the most important sector in the market, XLK, the most highly weighted in the S&P 500. Technology. Let's take a look at it. We've got a primary uptrend off the swing low that's off the page. Then I've got a more generous trend line off of the November low, which is your dotted brown line. Now, take note, as it stands now, this has a double top look. Why? Because we stalled at 144 back in April. We had 2 tries there. That was a double top in itself. You got to sell off. So at this high, we were here in momentum and here in RSI, and now we're back at the same level on price, but at much lower momentum and RSI levels. So that's a yellow flag. And I think the trade here is relatively simple. You break out above 144, you get long, right? You took out the prior highs, you took out this level, and now you can get long against that well-defined top. Set your stop at 143, and hopefully then you'd be off to the races with technology running. And in that scenario, you would probably see rates falling, like we talked about. A falling rate environment will be juice to the tech trade. And if you see, Apple, Google, Facebook, Microsoft making bullish moves, this is going to break out for sure. So if you don't want to play individual names, I think 144 is your level. I don't think it makes a lot of sense right now to try some cute short on technology. It's been resilient. What's your potential downside here? $4 down to the 50. I think that might be a hard trade. What would be easier is wait for this generous trend line to break. That way you'd be below all the moving averages and below the 50. So if you wanted to, you could set an alarm at, say, 138. And then I think if it rolls over to that extent, it's going to come back down here to 132. And, we could probably safely say tech's in a little bit of trouble, seeing some corrective activity. And then remember how double tops and double bottoms work. If price were to break back below 132, then the measured move is going to be, let's call it 144 down to 132. That's $12. And then $12 from 132 puts it down at 120 on a measured move. So if this double top truly executes with a break of 132, then you'd be looking at 120 as a measured move technical target. But that's putting the cart way before the horse. We got to see what happens here at 144. So that's where I would set my alarm. If you get that 144 trigger, I would get long. Staples, I haven't spent a bunch of time even looking at the chart, but here's what I see. You've got a ledge of support here at 70.50, large volume over price support bar. You can see price has struggled up here at the top. We did have a divergent high. Down here at this level, we had very high momentum in RSI, and it's been bleeding off ever since, even though price did advance. So 70.5 is what the bulls need to hold. If they can't do that, then you got the 50 down here at 70. Then you've got a ledge of support at 69.50. I think that trade is, a tough one to make, honestly. This is a defensive sector, and, so you take a trade at 70.50, and then it bounces off the 50, and then it spends some more time, and then it comes down. I mean, you're fighting for $1 there, right, to the next level of support. It's just not worth it. So if you want to stay long against 70.5, that's fine. Or if you want to watch this because you've got staple names like Kimberly-Clark and got Clorox and all these other names then you can use that as a proxy. But for me, there's just not enough happening at this level to really warrant a short. Now, if you got down here at 68.5 and look like everything is falling apart, then you can get some more running room. And then certainly if you lost this level here, the primary uptrend line, then you really get into some liquidation. But right here at the top, I think it's a harder trade to take. Utilities had this symmetrical triangle form with the apex right at 65.50 and broke out. What you're really looking at there is a falling rate environment where the rates are falling. That's usually helpful to utilities. And you've got a bull cross here on PPO, and you've got RSI breaking back above 50. So that's in its bullish regime. If you really wanted to do some kind of trade here, I would set an alarm at 67. And if it breaks above, then you can be long. If it comes back here and loses 65.50, then you may have a chance to get a run back down here towards the 200 at 63 if you were motivated to take a trade on XLU. XLV is an important, more or less defensive type sector. Again, we've got that double top setup. We've got falling momentum, yet price is at the prior highs. I think if you set an alarm at, say, 125.50, we've got 125 as being resistance. If you get a break above and say 125.50 or 126 for sure, you'll be breaking out to new highs. Momentum will take out these downtrends, and then you could be off to the races on a break above 125.50, and then set your stop just below. Here's a intermediate trend line. If you lost, say, 123.50, there may be some downside there back to 121. But again, you've got the 50 in between. That'll probably act as support. So I wouldn't be too motivated to, try a short. I think once this primary trend line breaks, then you've got chance for much bigger downside once the primary trend line breaks. But up here, when you're fighting all these moving averages, it's a tougher trade to take. So I'd be more motivated to look on the long side. I'd set an alarm here at 125.50. And then finally wrapping up XLY, which is a proxy for Amazon at 24% of the index. Very difficult for XLY to make, big explosive moves unless Amazon is participating. But then if it does, then, more power to it. Nice little consolidation triangle right here against 173.50. And you can see that price is battling overhead resistance, but with all the EMAs clustered right below it. And I think this one really has the potential for an explosive move, either higher or lower. Let's look at the reasons why. RSI, bearish regime, pinned down, not making any progress. We had the down move in momentum, and now we've got a little up move, but momentum starting to curl over. And in my experience, when you get a weak bounce and PPO starts to curl over below the zero line, and you get that bearish cross and momentum with RSI turning down, that's when the resumption of the downtrend occurs. And we've got a beautiful line to shoot against. We've got this primary uptrend line. We've got all the moving averages right there. So for my money, set an alarm at 174 for the breakout. And if you get that breakout, there should be a lot of power behind it because of this EMA cluster right below and all this energy being built up in this triangle. You get a breakout here above 174, I think you can almost count on a quick run to 180 and then potentially a breakout there to blue sky territory. So I like a long idea above 174 with all these EMAs clustered below acting as support. Now, if it goes the other way and you break this uptrend line and now price is below all the moving averages, it's just the whole thing in reverse. I think there'll be a lot of energy there, and I think there'd be a really good chance to come down here to 164 at this at the bottom end of this value range right here. So I would be alarming, let's call it 170, 150. And then you'll get that alarm and you can fine tune it from there. So I see 174 and 170, 150. You get a downside break. You can get short against the 50 with a stop just above, and then you'd be looking for 164. So I think this is a really interesting setup, probably the most interesting setup of all the sectors, just because of the positioning of the EMAs and the fact that you've got a well-defined upside and you've got a well-defined downside with room to run in both instances. And I think either one of those, whether it breaks out or breaks down, is going to be a very good risk-reward ratio, because they do have $6 to $8 worth of movement before they're going to hit any significant either overhead resistance or downside support. So I really like that. Okay, let's just do a quick review of what we got. The sector ETFs are the tides. They rise and they fall. If you're a guy that doesn't want to worry about earnings, that doesn't want to worry about, individual stock risk, they're great ways to trade. Remember, they're cap weighted. Understand which of the main individual stocks control that particular ETF. For instance, Amazon here and XLY. You've got Chevron and Exxon and energy. You've got Facebook and Google in communications. XLK, you've got Apple and Microsoft and those names dominating the index. So you can choose whether to camp out in a sector ETF or drill down to individual boats on the tide that's either rising or falling. So let's see how the Fed plays out this afternoon. I've given you all the pivots and key levels on these sectors. Set your alarms because you're sure to forget. And remember, there's going to be a lot of volatility, or the potential for a lot of volatility after the announcement and the presser. If you get an alarm that goes off, at 2:01 p.m. this afternoon, that doesn't mean, oh my God, pile into XLY, we just broke out. You got to wait and see if it's real. And that's kind of the conundrum with these Fed announcements. A lot of times the first move is fake. And so you pile in and then, tomorrow or Friday, they reverse it. And then, you're stopped out of everything and you're really frustrated. So keep that in mind as we go through the afternoon and tomorrow. And that way you'll have a better chance of taking a real trade rather than a head fake move. So if you're new to the channel, I hope you found the information beneficial. Hit Hit the subscribe button and the alarm bell. You'll get extra content as I produce it. Longtime listeners, I really appreciate your continued support as well. So let's wrap it up there. This has been Chris Buss with Traders Profit Compass. Talk to you next time.